All right, so I'm going to wrap up chapter 4. I've got a couple of last things that I want to talk to you about. So these are two ratios that I want to talk to you about that are balance sheet ratios. And so we need let me draw up a quick imaginary balance sheet. So we have, remember the balance sheet has assets and liabilities and owner's equity, right? So we've got left and right sides. Broadly speaking, we have a category of assets at the top that are our current assets. So let's just quick review. Cash, accounts receivable, inventory, there'd be short-term investments. There's a handful that you need to kind of remember where they go. So let's imagine our imaginary firm has $50,000 in current assets. Then it's going to have its long-term assets. So those would be things like net PPE. Right? Let's assume they have, say, 30 net PPE, and then they have long-term investments of, say, 20. We total that up, total assets, 50 plus 30 plus 20 is 100, okay? Then on the right side, we start with the liabilities. So we would have current liabilities. What are the most common current liabilities? Accounts payable, accruals, current portion of long-term debt. That's good enough. So let's imagine that this company has $25,000 in current liabilities. It then has, say, bonds, so long-term debt of 25 as well. So then we have total liabilities of 25 plus 25 is 50. And then we'll just say it's got owner's equity. Let's say it's a for-profit company. It's got owner's equity of how much would it have to have of owner's equity? 50, right? Because you've got to balance out the balance sheet. It's got to, if this side adds up to 100, this side has to add up to 100. So if we know they had 100 in assets, 50 in liabilities, then they must have 50 in owner's equity for a total of 100. So that balance sheet is balanced, meaning it's got the same values on both sides. All right, so I want to show you two ratios and kind of a measure. So the first one, the measure is called net working capital. Net working capital. Net working capital is really simple. It's current assets minus current liabilities. That's it. Okay. Current assets minus current liabilities is net working capital. Working capital is the resources that the organization has readily available to it to work with, hence working capital, right? So that's its cash, its inventory, other short-term, basically it's all the current assets. That's the stuff that the organization has to do its business. And so that is the definition of, and then we subtract from that its current liability. So if it's got short-term bills it's got to pay, then it can't mess around with the cash. With cash, it's got to have the cash set aside to pay those short-term bills, right? So, so net working capital is an important measure because it tells us how liquid is the firm. But it tells us that in a very absolute way. So the answer here would be, we go up here, we find current assets, that's 50. Current liabilities, right, 25, gives us net working capital of 25. So the problem with this is it's an absolute number, it's 25. So the question is that good? Is that bad? Is that enough? Right? And that's really the question you want to ask is that enough? Is this, and what we're trying to measure with a measure like net working capital is, we're focused on its liquidity. The question we want to ask is it liquid enough? Is it safe? Right? And so when we're talking about, is it safe, what we're saying is, do they have enough cash on hand, really, or stuff that they could turn into cash so that they can pay their bills and they aren't at risk of not being able to pay their bills and therefore going bankrupt, right? And getting sued and, having to be shut down. So that's what we're after. So is 25 good is really hard to answer because you don't have a benchmark to compare it to, right? And this is kind of the problem with, so net working capital is a useful number, but it's not, and even if we said, well, let's compare them to, a similar sized organization that maybe has 150,000 in assets. That's pretty close, Well, that could be radically different, not working capital number. And so then you don't really know. So when we get into these kind of measures, we always want to have a benchmark of some sort, something to compare it to, okay? So this one is hard to say. It's useful to know that number, and you could use it for some analysis. And you'll use this kind of measure when you get to the capstone course in senior year, when you're being asked to really look at an organization and diagnose its financial health. I prefer, now it's kind of like when we look at benchmarks like these, when we look at ratios and measures like these, it's a little bit like driving your car, right? So when you're driving your car, you want to look at, you've got your dashboard in front of you, you've got multiple measures of what your car is doing, right? You've got your speedometer that tells you, how fast are you going? You've got your odometer that tells you how far you've gone. You've got your gas gauge, that's kind of important, like that, you need to know if you've got enough gas, right? Maybe you pay attention to your RPMs, how hard are you driving your car? Engine temperature, you don't want that to go up into the red, or you're going to find yourself on the side of the road. So you've got a bunch of things. Some of those you don't pay a whole lot of attention to, right? Like, unless the engine light is blinking at you, you're probably, you're not really even thinking about it on a day-to-day basis, but it's there to warn you if there's a problem. So we've got all these ratios, and we'll get at chapter 17 is nothing but ratios all day long. So we'll get into a lot of those when we get to that chapter later on. I'm just introducing a couple of them. So this is a measure like your gas gauge or something like that, right? It's a measure you'd want to know, but it doesn't tell you the complete picture. Another measure is called that's related to this one is called the current ratio. So this is not a ratio, this is an absolute measure, right? The current ratio is drawn from the same data as the net working capital measure. And it is simply current assets divided by current liabilities. Okay, so in this case, our firm has 50,000 in current assets and 25,000 in current liabilities for a current ratio of 2. Now it's a little easier to work with a number like, so this is why ratios are generally better to work with than absolute numbers if you are trying to compare your organization to another organization. So now you could say, okay, we have a current ratio of 2, which means for every dollar of liabilities, I have $2 of relatively liquid assets that I can use to pay off my liabilities. So I have a 2-to-1 ratio of current assets to current liabilities. That's probably pretty good, right? But you'd want to, every industry has a set of benchmarks that said, is that good or is that not good, right? So and they're going to be different depending on the industry. So a nursing home tends to be more illiquid than a hospital. Hospitals tend to have a higher cash amount. Insurance companies will have a different current ratio than hospitals. So it really depends on the industry. So you want to know the current ratio. And all things considered, a higher number is better. Why would higher be better? All other things equal. Why is higher better? Yes, so why is that important? So you can pay your bills, right? So Caitlin said, more is better because you've got more assets relative to your liabilities, right? And so having more cash on hand to pay your bills tells you you are safer, you are more conservative. So you can take that to an extreme though, and have, a current ratio of 1,000 to 1, let's say. That's probably too high. That probably means you're being too conservative. You've got too much cash on hand, right? And you're not using your cash to invest in your real property or other kinds of investments, right? Even just taking some of that cash and putting it into a CD so you can earn some interest instead of zero interest on your bank account. Emma, you had a question. Is it accounted for? I'm not sure. I mean, you mean, is it earmarked to a particular It's not just cash, right? It's all your current assets. So just to be clear, so Emma's asking, is some of the current assets earmarked for some of the current liabilities? Possibly, but that we don't take account of that for this purpose. Okay, so now we have, these are two short-term measures of liquidity. They're both based on our current assets and current liabilities. So they're focused on our short-term viability of the organization. I'm going to give you one long-term measure. And that is the debt ratio. And the debt ratio is asking, well, the debt ratio is simply total liabilities divided by total assets. So in this case, total liabilities is 50, total assets is 100. So we have a debt ratio of 0.5 or 50%. So what does that tell us? That tells us that half of the organization is financed by debt and half of it is financed by equity. Why do we care about that? Well, if we have a liability, if, say, you have a car, right? A lot of you guys have cars and a lot of you guys have car loans, right? So if the bank owns half of your car, what that means is you're going to have to make payments. What's implied by this is you're going to have to make payments to the bank for your car. If you don't own your car outright, right? If you have a loan on your car, it implies you have to make payments to the bank. It means that you have to make payments to the bank whether you're made a lot of money working at, the Supery this week or not. The bank says, pay me, pay us your loan at the end of the month. Doesn't matter, whatever your part-time job is that you're currently, making your money for your beer money and your car payments. The bank doesn't care how much money you made, how good your tips were, or if your business had to shut down because of COVID. Doesn't care. It wants to be paid, right? So the more debt you carry, the more pressure you have as an individual or as an organization. It doesn't matter, right? The more debt you carry, the more fixed payments you have to meet every month, or whatever the period is of your payments. For you guys, it's probably at least monthly. So the more debt you carry, the larger your debt ratio, the bigger that regular bill is that comes in that you have to pay. Now the problem is the bill stays the same, right? The financing arrangement is going to stay constant. Your car payment is always $100 a month or $200 a month or whatever it is. And it is completely independent from how much money you're bringing in from your job, right? Those two things are not connected. So the same thing in a business, right? If you're running a hospital and you've got a whole bunch of bonds out there that expect to be paid, bonds typically are paid every 6 months. They expect to be paid every 6 months, or if you've got a mortgage on a building that's got a monthly payment, the bank or the bondholders expect their payments every month on a fixed basis, right? But your revenues are completely independent from that, right? So if you've got a bad flu season, that's good for business, right? If you're a hospital, you got a bad flu season, it's good for business, right? It's kind of one of those wacky things about our industry, right? When everybody's sick, we're raking in the dough, except COVID, then we have to shut down, right? And we don't make any money hardly on the COVID patients. But, you know, normally, you know, winter's a great time for making money on, you know, people getting sick. And so, but if, you know, if you wind up with a situation like COVID, so this is a problem, a real problem that a lot of hospitals are facing right now. So there are a number of hospitals that have very high debt ratios in New Hampshire, right? We could talk about them offline. I don't want to embarrass anybody, any of my friends. But there are hospitals that have very high debt ratios, which means they have very high recurring payments. And as a result of COVID, particularly back in the spring, they basically shut down their hospitals. They shut down all their operations where, you know, the vast majority of their revenue was coming in, you know, to the tune of like, they lost like 60% of their revenue. Well, the problem is the bondholders are like, hey, pay us, you know, keep paying us. We don't care about your problems. Keep paying us, right? I'm being I'm exaggerating that a little bit, but not much, right? The bondholders will eventually force you into bankruptcy and take your stuff if you don't pay them, right? So that's why this is risky. The higher this number is, the implication is you have a higher fixed cost every month from interest payments that you have to make, right? And principal payments, depending on the nature of the financing. So in general, like all other things equal, lower is better in this case. So whereas higher was better for current ratio, all other things equal, lower is better here from the perspective of being conservative, right? Higher is better for current ratio from the perspective of being conservative, because in finance we're conservative, because you can pay your bills. In this case, again, from the perspective of being conservative, lower is better because it allows you to pay your bills, right? You're more likely to be able to pay your bills if you have a relatively low debt ratio. So now that said, right, in reality, a debt ratio of 0 is not good. In just the same way that a current ratio of 1,000 is not good, right? They're both, a current ratio of 1,000 and a debt ratio of 0 is overly conservative. So there is like a Goldilocks kind of number that you want to shoot at. So for hospitals, it's somewhere around 40% debt ratio. For a nursing home, it's more like 70 or 80% debt ratio. So it depends on the industry you're in, but there are benchmarks that say what your debt ratio ought to be at or around. Well, the higher, and the reason is, borrowing money is a way to amplify your ability to deliver goods and services, right? So Wentworth Douglas borrows money to build a new patient tower because hopefully they can afford it, right? And it allows them to provide more care than if they tried to finance their new building purely out of earnings or donations. They can do more by borrowing money, and that's why businesses borrow money, right? It allows them to increase the amount of goods and services that they can provide. But if you borrow too much, right, you put yourself at risk. You have a degree of it's called financial leverage, like a lever and you're jacking something up, right? So you become overly leveraged. And if you're at 80 or not, if you're a hospital at 80 or 90%, people are going to get investors and or any lenders will look at you and say, you are so highly leveraged right now that I don't want to lend you any more money because I'm worried that you're not going to be able to pay me back. So a really high debt ratio is a signal to lenders and or potential equity holders that you are over leveraged and you are at risk of going bankrupt. So too low means you're being too conservative, right? Too high means you are at significant financial risk. So you want to hit, I jokingly call it the Goldilocks numbers, right? But you're going to have kind of a industry average for debt ratio. For all these ratios, you're going to have an industry average. And on top of that, you'll have an industry average for the size business that you are. So there's a different industry average for all of these for a community hospital, a Wentworth Douglas or an Exeter hospital versus a Mass Gen, right, teaching hospital, right? Those are two different animals. Even though they're both hospitals, they're going to have different numbers. And so you're going to typically, when you look at these numbers, and we'll do more about this, like I said, when we get to chapter 17, more detail. But so you'll have variation across business, across different industries, right? And then you'll have variation within industry based on the size of the entity. Okay, so the big thing, so those are the three things I wanted to, that I wanted to kind of close up chapter 4 on. So net working capital is an important number to tell you how much do I have, but it's an absolute number, right? I have 25,000. Okay, is that good? Really hard to say unless we start getting into some ratios. So the ratios for the basic balance sheet ratios are the current ratio that tells you kind of the short-term financial health of the organization. Do they have enough to cover their short-term obligations? And then the debt ratio tells you kind of in the long run, do they have additional, so the other question is, do they have additional capacity to borrow, right? So if the industry average is 50 and I'm currently at 30, banks are going to be more likely to say, sure, I'll lend you some money. But if the industry average is 50 and I'm at 70, banks are going to be like, nah, already loaned you a lot. You already been to the trough enough times. How about you pay down first, and then maybe we'll talk about a new loan, right? So that's the risk there. So the long-term measure, the debt ratio, tells you the overall financing of the organization, but it also gives you a sense of how leveraged is the organization in terms of its ability to likely to be able to pay back its loan. So both of these measures, current ratio, debt ratio, are kind of about the financial security of the organization, that they take a short-term look and a longer-term look, okay? All right, so I'm gonna stop there. That was the one piece I realized we hadn't covered. So I'm gonna stop there for chapter 4. I'm gonna stop my recording, make that separate recording.